you for coming here today and taking the time to listen to what we have to say. For most of you, this is probably the first time that you're going to hear me give an outlook. Obviously, I prefer to keep a low profile. Not because my peers in the industry are more photogenic than I, but really, since childhood, I actually have a fear of public speaking. So forgive me if I tend to stop and stutter from time to time. Okay. Again, this is our market outlook for the second half and going into the first half of 2019. But before that, just like to give you a quick review of our stock picks for this year. And this is through, actually this is through the midday of today, mid trading this morning today. So our stock picks have been doing pretty well. Our 10 stock picks have outperformed the index on a weighted average basis by more than 700 basis points, which I believe is quite good considering that the market has not been too bullish in the past 6 to 12 months. Also, some of our first half calls have been doing very well. Holcim, GSMI, Cemex, CLI, Pepsi, and First Philippine Holdings are among the stocks that we recommended in the first few months of the year, and they've been giving solid returns since we made those calls. Okay, so going formally now to our outlook, it's called a window of opportunity. I've actually been mostly bearish in the past 3 years, and this has been borne out by the fact that the market has actually been flattish in the last 36 months. Towards the end of last year, I turned neutral, but now I think it's the time to take a deeper look into equities, because I think there's more opportunity at this time. Our framework goes like this now. These are the factors that we look at every time that we do a market outlook. These are inflation, interest rates, monetary policy, fiscal policy, of course GDP, external factors, earnings, and valuation. And we'll go through each one. First, on inflation. Obviously, inflation has been coming down, and we think that in the second half of this year, it could go down to as low as 1%, maybe even lower, primarily because of a very high base last year and because of policies that have been put in place to arrest inflation. However, some of these policies have been very costly. Liberalized food imports have widened the trade deficit. These policies have also hurt a lot of our farmers. Rice tariffication is negative for farm incomes, although it helps the average household save on food costs. It is also hurting our farmers. I think if you read our short takes today, we showed their computation that the lost income of rice farmers actually outpaces the savings of households in terms of rice consumption. Also, if you look at the core inflation, it's still higher than the midpoint of the Bangko Central's target range. So this is still something that we should look at. And we believe that this is one reason that headline inflation may again rise above 3% next year. Next is interest rates. Because inflation has been going down, interest rates have followed suit. But aside from decelerating inflation, of course, the BSP has been advocating a looser monetary policy. There's also been a slowdown in developed economies. and falling global yields have been falling dramatically over the past 6 to 9 months. You can see that in the chart below. From about $6 trillion worth of negative yielding debt in late 2018, this has suddenly ballooned to close to $14 trillion presently. Lastly, the National Treasury has a lot of cash right now, so they've been able to reject bids that have been too high, and money market traders know this, and that's why they've been bidding Treasury bills lower and lower the past few weeks. However, we believe that rates may have overshot to the downside. As you can see in the chart above, the yield curve has shifted much lower in the past in the past 6 months, past 6 months alone. The yield curve has shifted about 150 basis points downward, and this implies that the market is pricing in already that the BSP will cut rates by similar magnitude in the near term. However, we believe that this is unrealistic, and we'll discuss that in a while. Now, monetary policy. As we've said, monetary policy has become much looser under Governor Jokno. We believe that he is a Keynesian, and he will be an advocate for looser monetary policy moving forward. The key overnight rate and required reserves, therefore, will continue to go down over the next 12 to 18 months. Again, however, the pace of reductions may not be as fast as the market expects or hopes. If you listen closely to Governor Jokno's comments, you will hear him say things like investors have to have patience on rates. He also said categorically that the reserve ratio requirement will be single digits by the end of his term, which is still 4 years away. So to expect that reserve ratio cuts totaling 800 basis points over the next 2 years, for example, is, I think, too quick, and the market will not be able to absorb that. So on our view, it will be a very gradual pace of reduction in terms of the reserve ratio requirement. Moving on to fiscal policy, this is one positive also for the market. All the other factors that I've mentioned so far, those are all positive for the market. For fiscal policy, this is another positive for the market. However, expansionary fiscal policy has its limits. Last year, we hit 3.2% deficit to GDP, which we believe is too high for an emerging market, and foreign investors are always on the alert when it comes to emerging markets surpassing a deficit to GDP ratio of 3%, which is oftentimes unsustainable. Second, we've been saying for the past few years that there is a skilled labor shortage in the country, and even as the government tries to build out infrastructure, they will run into significant constraints simply because there are not enough warm bodies for all these construction projects. Just to give you an anecdotal evidence, my wife bought a condo from Alveo Land in 2012. It was supposed to be delivered 4 years later, so that was 2016. But it was the turnover started in 2018, and one of the reasons that they gave us for the delayed delivery of the project is skilled labor shortage. So if a company like Alveo Land, which is under Ayala Land, is experiencing skilled labor shortage, then what more the smaller developers and what more government contractors who probably pay lower compared to private developers. So skilled labor shortage for us is a very key constraint with regards to infrastructure spending. On the other hand, we've seen government statistics saying that infrastructure spending has risen as a percentage of GDP, as you can see in the chart below. However, the impact has not been palpable in our view. Remember that train was supposed to, tax reform train, was supposed to raise revenue that would fund infrastructure projects, and that these infrastructure projects were supposed to bring GDP growth to 7 to 8%. However, what we've seen is that GDP actually slowed down. 2018 it went down to 6.2%. First quarter of this year it's down to 5.6%. So for us, the revenue collection side was successful. It was a success. They were able to raise the revenues that they set out to do. However, it appears that the spending part remains a lot to be there remains a lot to be desired with regard to the spending side. Next, flagship projects have not actually taken off. One of these projects is the Manila Subway. They broke ground in quotation marks. They broke ground in February. However, we've been monitoring progress, and there's actually not even a hole in the ground right now at the site. And we were able to talk to EEI, one of the construction joint venture partners, and they said a few months ago that the tunnel boring machine, which is supposed to do all the hard work, has not actually been ordered yet. And if that has not yet been ordered, it's going to take 12 months at least for the lead time. That lead time is construction, testing, and then delivery to the site, and then assembly of the tunnel boring machine on site. So the earliest that actual digging, tunneling will start is probably second half of 2020. And remember that these tunnel boring machines only move about 50 feet per day, 50 to 60 feet per day. So to finish, if the work is consistent, no, every day they dig 50, 60 feet per day, it's going to take at least 6 years to finish the entire length. So we don't believe that the first 3 stations, for example, are going to be finished in 2022. We don't believe that it will be operational. The entire length won't be operational by 2025. So I think that the market has to have more realistic expectations with regard to infrastructure spending. Next thing is that the contribution of government spending to GDP growth has probably peaked already. Remember that in 2017, we were coming from a deficit to GDP ratio of about 2%. Last year, deficit to GDP went up to 3.2% already. And that is why in the second quarter of 2018, the contribution of government spending to GDP, as you can see in the chart, was about 1.7%. 1.7 percentage points of the 6.3% growth in the second quarter of last year came from government spending alone. Now, in the first 2 months of the second quarter this year, government spending was actually down 3%. So, what we're looking for now, what we're expecting now for second quarter GDP is that the contribution of government spending to GDP growth will be very minimal, something like 0.1, 0.2 percentage points to GDP, maybe a high of 0.5 percentage points. But that leaves you with a huge hole. More than 100 basis points of GDP growth will be practically wiped out for second quarter, and we don't think that the other components of GDP will be able to make up for the difference. On the other hand, the delayed budget was actually may have been a blessing in disguise. If not for the budget delay, we think that this year's deficit to GDP ratio would have again breached the ceiling, maybe even worse than last year's 3.2% to deficit to GDP. Treasury now is awash with cash, and this has contributed to lower interest rates, and maybe this sets up better GDP growth in 2020. So I was saying GDP growth, it's still going to be disappointing. It will probably be slightly better than Q1's 5.6%, but it will still be below 6% in our view. Again, the impact of government spending will be muted compared to last year. The delayed budget is definitely going to be a drag. As I said, April to May government spending was actually down 3%, and hopefully June is better. Agriculture may turn negative because of El Nino. And then, as you can see in the bottom part of the chart, money supply growth and bank lending growth have been on a very steep downward trend in the past few months. And on our numbers, M3 growth and GDP growth are somewhat correlated. It's not very significant, but there's still some correlation with regard to M3 and GDP growth. And of course, if loan growth is slowing down, companies are basically not borrowing for their operations. It suggests to us that it's also a negative for GDP growth. Now, second half growth will probably be significantly better. However, even if the economy reaches 6% growth for the full year, it would still be a letdown because, as I said, train was supposed to bring GDP growth up to 7 to 8%. Next is on the exchange rate, basically. We don't think that the market or investors should celebrate the peso's recent appreciation. This is because the balance of payment surpluses that we've been seeing in the past 6 to 7 months and the higher gross international reserves that have been reported have been largely due to two things. Sovereign debt issuances amounted to almost $3 billion, for example, in the first 6 months of the year. Second, because of the delayed budget, a lot of imports have been foregone in the first 6 months of the year. So now that the government is trying to catch up on spending, this is going to reverse in the second half of this year. Second, the BSP is actually forecasting a much wider current account deficit for the year as a whole. This, of course, means that the Philippines as a whole is earning less dollars than it spends, and the only reason that gross international reserves is rising is because of borrowings, or one of the main reasons that gross international reserves is rising is because of borrowings. So we would actually be advocating to buy the dollar at 51 or lower. Again, imports are going to resume growing in the second half. We also believe that lower US rates have been priced in. And these lower US rates are one of the main reasons that the dollar has been very weak, and that one of the main reasons why emerging markets currencies have been very strong in the past few months. Now, there's been some pushback on this. The latest jobs numbers from the US were much stronger than expected. Expectations for a rate cut have declined a bit. So again, lower US rates have been fully priced in, basically priced to perfection already. So a little bit of disappointment on that front might send the dollar stronger in the next few months. Foreign direct investments are likely to disappoint further for the balance of the year. Just this afternoon, it was reported that May foreign direct investments were down 11%, and this brought the year-to-date total to negative 14%. And if the San Miguel Holcim deal is approved, that's going to be a huge FDI outflow. That's $1.9 billion. So that's going to impact your FDI. That's going to impact your peso-dollar exchange rate. Lastly, because of the moratorium on BPO offices, PESA accreditations, BPOs are going to slow down even further. So again, we would be buyers of the dollar at 51 or lower. Now, everyone's probably familiar with this. External environment is basically negative. The trade wars that the U.S. has initiated on various fronts is likely to extend into next year. Recently, there was a much talked about trade truce between the U.S. and China. However, there has actually been no timetable set for the resumption of talks. So this is probably going to, again, it's probably going to extend into next year. Next, there's been heightened tension, of course, between the U.S. and Iran. The picture there shows one of the oil tankers that was attacked in the Strait of Hormuz a few months ago. Next, the last two candidates for the position of Prime Minister in the UK have both declined to rule out a no-deal Brexit scenario. So this is going to be one of those negatives for markets in general. The other day, Turkey replaced its central bank governor. Now, the US, of course, is not an emerging market, but you've probably seen reports that President Trump has actually looked into the possibility of demoting Governor Powell, Chairman Powell, from his position. So how will markets react, for example, if Trump forces out Powell? Next is the odds of a U.S. recession have spiked to about 32%. This is the highest since 2008. And some say that when odds of a recession go higher than 30%, there's no turning back. So the odds may be just 32%, but it becomes more and more likely at this point that the U.S. will tip into a recession, maybe by next year. So maybe this is why global yields have been falling. So there's a dark side with regard to lower interest rates globally. For corporate earnings, the good news is that first quarter earnings were much better compared to the last 2 to 3 years. It accelerated to 9% from about 6% last year. However, the plurality of companies that reported, the plurality of companies reported numbers that were actually lower than expected. So more companies submitted first quarter numbers that were weaker than expected. Now Q2 earnings should sustain the positive momentum, but we still think that the market is a little too optimistic with regard to earnings. As you can see in the chart below, nominal EPS forecasts for the Philippine Stock Exchange Index have declined for both 2019 and 2020. For 2019, it was 481 in December, late December. It is now currently 463. That 18, that difference of 18 might seem small, no? But if your earnings multiple is something like 18 times, then actually your index target has moved down by about 300 points or more than 300 points. So 18 is not an insignificant number. Meanwhile, we don't think that 9% EPS growth can sustain or cannot it cannot support 20 times valuation for the PSEI. So 9% is a little bit stronger, but still leaves a lot to be desired. Next, on valuations, the market right now is trading near or at its 10-year median. Some of our peers use a 5-year average. We prefer to use a 10-year average because we believe that 5 years is too short. It is too short to account for all the peaks and troughs that markets go through over time. Meanwhile, the PSEI has retained its premium over its regional peers, so it again limits the upside, especially since EPS growth is still lukewarm. The biggest positive, however, is that the PSEI earnings yield, or the reciprocal of the PE, is now greater than the 10-year yield. So this means that equities have become much more attractive relative to fixed income, and this is a pretty recent development. So there's still, in our view, there's still a lot of potential upside for the market simply because fixed income yields have gone down so much. So to recap our framework, inflation, interest rates, monetary policy, all positive. I put there double positives because they are significant, very substantial positives for the market. Fiscal policy, I said earlier, it's positive, but because the impact has been maximized already in 2018, so fiscal policy now is probably more neutral than positive. GDP negative, weakening current account is negative, external factors are negative, earnings are still negative, and then valuations are more or less neutral. But overall, we believe that the risks are now tilted to the upside. So now we're not bearish anymore. We're not neutral. We're actually more positive on the market right now. Primarily because of the factors that I mentioned. For the rest of for just to summarize further, looser local and global monetary policy is a positive. However, we should be on the lookout for the hidden risks of falling global yields, which is a recession for the US. Meanwhile, we should also be cautious. We should still be cautious because foreign funds have not yet been coming in, primarily because there have been actions on the part of MSCI and FTSE, adding China, Saudi Arabia, recently Kuwait, adding them to the emerging markets index, and this will continue to draw money away from other emerging markets like the Philippines. Locally, liquidity is going to improve because of looser financial conditions. We still don't think that the market is likely to recapture valuation highs of 20 to 21 times, but it's possible that we can surpass 18 times in the next 12 months, and this is what I was mentioning earlier as a window of opportunity, because interest rates have fallen significantly, because the earnings yield is now significantly higher compared to the 10-year earnings yield. We believe that the next 12 months will be relatively good for local equities. Now, the upside risk to our forecast is that if earnings accelerate to double-digit growth, then maybe if that happens, then maybe 20 times can be reached in the next 6 to 12 months. Downside risk, of course, is still lower than expected GDP and the twin deficit scenario. If deficit to GDP goes past 3.2%, and if the current account deficit goes past 3%. So those are the things that we should be looking out for. Now for our general recommendations, again, we believe that it's time to position for longer term gains. It might not seem, it might not be obvious now, no, but we believe that 2020 is when we finally reach 9,000 again, and maybe even reach a new all-time high in the second half of next year. Still, because of the risks I mentioned, it's still appropriate, in our view, to maintain sizable cash balances because volatility will still remain high. This is for potential bargains, of course, and to protect against tail risks, the ones that I mentioned on the externals slide. Now, we are overweight on banks, consumer retail, logistics, and cement. We are underweight on consumer food, telcos, and property. Now, our top trade ideas are a switch from SMS and Prime and into AC Ali, primarily because of valuations. Also because Ayala Land is probably going to be the first one to market with a REIT. Second is a switch from Meralco to FGen. The value, again, primarily because of valuations. Meralco is trading something like 20 times, whereas FGen is only about 8 times. And particularly on Meralco, the Energy Regulatory Commission has now put the ball in motion with regard to recasting the performance-based rate of Meralco, and this will come out maybe in the next 6 to 9 months. And we expect a significant / substantial reduction in the distribution rate of Meralco. And this is going to cause a significant price correction for the stock in our view. Now, and lastly, a switch from restaurant stocks into retailers, which I will discuss in detail later. Now, just to discuss our picks now. Consumer retail, you can see in the charts there that same-store sales growth for restaurants have been much weaker compared to same-store sales growth for retailers. First quarter, these are for first quarter numbers. Restaurant stocks posted same-store sales growth of just 1% in Q1 versus 6% for retailers. Restaurant stocks are also trading at higher valuations compared to retailers. Meanwhile, because of the peso's appreciation, margins for retailers are likely to improve. Some of them marginally, some of them more substantially, starting from this quarter, but more towards the latter part of this year. Our top picks here are MRSGI on a recovery play, and then Wilcon. However, we prefer to buy Wilcon at lower levels. Transport and logistics. This is a niche in the market that is largely overlooked. But we like it because it is highly correlated to the economy and because it is highly correlated to high growth industries. They are beneficiaries of long-term megatrends. One of those is higher and higher disposable incomes, and second, larger and larger proportion of online retailing as compared to brick and mortar retailing. So here our top picks are Macro Asia and LBC. LBC hopefully will have its follow-on offering soon. Hopefully, if they can get SEC approval. Banks. We are overweight on banks because it will benefit substantially from the improving regulatory environment. Interest rate cuts are going to help boost loan demand moving forward, and reserve ratio cuts are going to boost their margins and returns on equities moving forward. One specific thing that we like about the sector is that it is a laggard. The year-to-date performance of the banking sector trails all the other sub-indices except for mining. Next, the industry as a whole is trading near the bottom of its 10-year price to book band. So if you're a believer of mean reversion, then eventually these valuations are going to come back to median levels at the very least. And this sets up a strong opportunity for a lot of these banks. And for here, our top picks are Metrobank and East West. Now, to discuss our picks one by one, we like Metrobank with a price target of 91. Of course, it's trading below book. We believe that it's going to benefit when car sales recover. Metrobank is the largest underwriter of car loans, simply because of its relation to Toyota Motors Philippines. It's also the cheapest among the big three, and its underperformance over the past year or two should eventually reverse. East West, we like East West because it's the cheapest in the in our universe. We expect it to recover starting this quarter, and we expect it to post much better numbers going forward. It was supposed to do a stock rights offering as well. However, because of the slowdown in loans, this has been delayed, and we believe that this is actually a positive for the stock, simply because SROs are usually very dilutive for at least 4 quarters. So the farther out the SRO happens, we believe that it's better for the stock. FLI, it has been stagnant for maybe 10 years. I think in those 10 years, its EPS growth was something like 3 or 4% compounded. However, we believe that the company is finally transitioning into a higher growth plane. Number one reason for that is its exposure to Clark, to Pampanga. Second reason is that prices in Philinvest Corporate City have actually been growing as fast as the Bay Area. If you've been following land prices, there has also been a huge jump in prices in Philinvest City, and they still have a huge land bank there, and FLI owns 20% of Philinvest Alabang. So I think we believe that again that earnings growth is now transitioning into a higher growth plane. Another reason that we like FLI is it's an under the radar REIT play. It's not one of those that you talk about often when you talk about REITs, but its ratio of recurring income to total is actually pretty high as well, and it actually approaches that of Mega World, where it's relatively close to Mega World. So we think that it's also going to be a REIT play if and when REIT rules are finalized, hopefully within the next 6 to 12 months. Now, Pepsi, we like Pepsi because last night, for example, Pepsi US reported for second quarter results, and one of the things that they highlighted was the Philippines. Philippine volumes, they said, were recovering and posted double-digit growth in the first half of the year. Another thing is that sugar prices are falling. You can see in the chart below the huge decline in sugar prices from last year's peak, and this is going to show up in the bottom line starting this quarter, and especially in the third quarter. Naphtha prices are also very low right now, and this is going to help their packaging costs. And by the way, if naphtha prices are falling, that's negative, by the way, for JG Petrochem. So watch out for JGS, second quarter numbers of JGS. Next is Macro Asia. As I said earlier, it's a beneficiary of a mega trend. More and more Filipinos, of course, are traveling. Higher disposable incomes are playing into that, and the best way to play that, in our view, is not through exposure through PAL or even Cebu Pacific, but rather through Macro Asia, because it serves both companies in terms of ground handling and catering. Next is LBC. Again, this one beneficiary of a megatrend. Online retail is growing 20-25% per annum, and LBC is the primary delivery partner of Lazada and Shopee. So if online retailing is growing 20-25%, then the proportion of LBC's revenues that comes from this is going to rapidly improve in the next few years. Again, hopefully the following offering happens in the near future, and this should help boost the share price for LBC. Next is LTG. LTG. We believe that the higher excise taxes that have been approved or passed into law have already been priced in. So there's little downside in our view moving forward. Now, PNB has a very aggressive new president in Mr. Veloso. PNB is building up a huge war chest. By our estimation, it's going to be more than 100 billion pesos by the time that they finish. And we believe that they're going to be able to maximize that, put that into work, and hopefully the returns on equities for PNB are going to improve significantly over the next 6 to 12 months. LTG is also among the cheapest among the conglomerates. So our price target for LTG is 21. MRSGI, it's going to be a recovery year again for MRSGI. The supermarket has had already been reopened, and we expect full operations by the end of the year. Remember that prior to the fire, MRSGI was trading at 3. So by the time that the redevelopment is finished by the end of the year, they would have opened 5-6 more stores compared to the start of last year. So at a minimum, in our view, MRSGI should go back to 3 pesos. It is, as you can see in the chart, it is the cheapest among the consumer plays that we follow. Next is Bloom. There's been improving sentiment in Macau. GGR numbers are improving, and this has led to higher valuation multiples for peers in the region. And because of this, Bloom is now among the cheapest gaming place in Asia, and we believe that there's significant upside for the stock. Meanwhile, the earnings have been hurt because of the loans that they had to take out to buy the Soler lot. However, the importance of that, the impact of that is going to fade over the next few quarters. And profit growth will normalize over time. Last is FGen. We like FGen because of its long-term growth potential from the LNG play. We believe that First Gen will be the first to finish the project, and this will redound to the company's benefit. They're going to add more capacity moving forward, and that's going to drive earnings growth in the long term. Price target is 29.50. It's pretty close right now, but we believe that there's significant room for or significant scope to increase that price target, because even at 29.50, I think that's just 9 times PE on 2019 earnings. So there's still a lot of scope for raising our price target for FGen. That's it. Thank you very much. If you have any questions.
Which particular sector or stocks will be heavily affected by the US-China trade war? do you foresee the trade war to ease in the near future?
I think the primary sector that is most vulnerable has already shown the kind of stress that is expected from a U.S.-China trade war. IMI, for example, has been reporting far weaker results than anticipated, simply because the global supply chain has been significantly impacted. There have been a lot of shortages in terms of that supply chain. Also, demand for cars have gone down significantly globally. I think the other day it was reported that Chinese car sales went up for the first time in 14 months. So, given that, I think it's already quite obvious that the main sector that has been hurt is really the manufacturing and export sectors.
Anyone from the floor who'd like to be the bold one to ask a question? Go ahead, sir.
Yes, sir. Siguro in the past few months, 'di ba, naging hot na hot yung mga stocks ni we call them DAO, 'di ba, si Dennis Uy. Aware naman yung market na marami siyang debts. Ano po yung opinion niyo regarding sa niya? Kasi ang dami niyang din 'di ba? Ang dami niyang mga companies na sa nasa stock market ngayon eh. Any advice po on how to trade yung mga stocks na yon, hindi lang C tsaka ISM kasi meron din siyang ibang stocks pa eh, di ba? Ano pong advice mabibigyan niyo regarding mga other stocks niya?
We don't officially cover any of those stocks, but what I can say is this. For example, yesterday Ramon Ang was quoted as saying that they are deferring the expansion of their Bataan refinery. One of the reasons he mentioned is that they can't compete with independent retailers. The independent retailers have an advantage, so to speak, that was caused by the train law. He explained that refiners like Petron have to pay the excise tax upon production of the fuel, whereas the independent retailers pay the tax after the sale. So that's a significant advantage for independent fuel retailers, and in that sense, Phoenix might be a good play because it could eat more market share from the big three. Actually, siya na pala yung third largest. I think Phoenix overtook Caltex last year or 2 years ago as the third largest retailer. So that's one positive for the Dennis Uy stocks. On the telco side, I think everyone has to be very realistic. The rollout is going to take years. The rollout is going to take billions of dollars. Chelsea and ISM might book significant losses for several years. So those companies are not something that I would personally look into.
Okay, another question being asked is, what will be the effect of the government's initiative to collect taxes from foreign employees to sectors such as gaming and property?
On the fiscal side, that's positive, of course. They're talking about 2 billion pesos per month, or 24 billion pesos per year. That's more than 0.1% of GDP. So that's going to help in terms of the deficit to GDP ratio. On the other hand, that's when they talk about collecting from 2 billion a month, they're talking about the legal POGOs. They're not yet even talking about the illegal ones, which probably comprise a bigger portion of the POGO industry. So when they go after those illegal POGOs, some of them might turn legal, some of them might leave. So that might cause a significant deceleration in office space demand from POGOs moving forward. So that's a negative by itself. But you also have to take into account that there has been a moratorium on PEZA accreditation. So it might become a double whammy for the property sector if there is a sudden drop off in demand for office space from both POGOs and from BPOs. So, and that's one of the primary reasons why we are underweight on the property sector. We are probably among the few who have a negative view on the property sector. Maybe we're the only one who has a negative view on the property sector right now.
Anyone from the floor? Any questions from the floor?
Hello, good afternoon, Nicky. I just wanted to ask, you mentioned earlier that there's a possibility of the US recession by next year, but you also mentioned that we might have a new all-time high by second half of next year. So if the US goes on recession, do you still expect us to have all-time high?
I mentioned the possibility of recession in the US, but at odds of 32% or 33%, it's still not a certainty. So our base case does not impute a recession for the US in 2020. Maybe a slowdown, but definitely not a recession yet. So our forecast for a new high for the index, maybe mid 2020 or latter part of 2020, includes the assumption that the US economy will continue to grow.
And then follow up lang din yung sa CHP, if you have a comment. It's down big today.
CHP probably correcting from significant price appreciation already. But we like the cement industry because valuations have gone down significantly. Second, cement prices have been going up. I think in our daily report we showed a chart showing that cement prices have been accelerating in the past few months. So this is going to redound to better margins, better bottom lines for all companies moving forward, and particularly for CHP because it has a very high operating leverage, and it's among the cement companies that are most sensitive to higher cement prices. So even if cement prices go up equally for all the players, it might have a larger effect on CHP simply because its operating leverage is higher than its peers.
Here's another question from the text line. Any comments on URC?
URC, late last year, everyone was bailing out on URC. That was when it was doing 120 pesos per share. But that was also the time that we made the contrarian call. We said that it was already at the point of maximum pessimism for URC, and we called the buy on it. Now it's trading at 170, 180 even recently. We think that the stock has already overshot fair value. A lot of investors now expecting a recovery, but we believe that at 32 times PE on 2020 numbers, we believe that the stock is fully valued already, and it might be prone to significant disappointment if second quarter numbers still turn out weaker than expected. So we would rather investors or clients look at alternatives for URC right now.
Anyone from the floor?
Cebu Pacific incident yesterday. In cases like that, how do you recommend investors to react on it? Do you touch it, or is it something like for entertainment purposes that because a lot of people are asking if they wanna take a look into it because of the human error that happened yesterday?
Hard to comment on that because yun nga, when it happens, you just suddenly realize that the stock is down 40% or something. You probably don't realize that some of us actually didn't even realize that it happened because it was already at the close of trading. So it's good that if you can take advantage of it, pero you also have to take a look at the other side of the coin. Kawawa naman yung trader on the other side on the other side. So it's hard to
But sir, fundamentally, how do you look at Cebu Pacific?
Cebu Pacific, in terms of valuations, very cheap. However, when we say that Macro Asia is the best play in terms of growing tourist numbers or growing propensity for Filipinos to travel, this is because earnings of airline companies really can be very volatile. Number one, because of foreign exchange losses. Second, because of fuel hedging losses. So it may be cheap, but for a lot of people, it may be hard to stomach the huge ups and downs in terms of earnings. So we prefer to have exposure to Macro Asia if you're trying to take advantage of those trends now.